$11 trillion vanished from Japan's economy in just 3 years. No cities burned, no factories bombed, yet wealth disappeared on an epic scale. The collapse came not from nature or enemies, but from belief hardened. The belief Japan had transcended cycles. This time is different. In 1989, Japan stood as the richest nation on earth by valuation and perceived financial power. Its economy was celebrated globally as the future model for capitalism, efficiency, and national success. Japanese growth appeared unstoppable, admired by allies, and feared quietly by American competitors. Tokyo became the epicenter of global finance, confidence, luxury consumption, and corporate ambition. Real estate prices reached levels that defied all previous economic precedent, logic, and affordability. Land values rose not because of income or productivity, but because belief demanded they rise. The land beneath the imperial palace alone exceeded the value of the entire state of California. This was not metaphor or exaggeration, but accepted market valuation repeated proudly at the time. No one questioned the logic because rising prices seemed to validate the theory every day. Japan's stock market reflected the same boundless optimism and expanding illusion of endless upside. The Nikkei index surged relentlessly upward without meaningful resistance, skepticism, or sustained correction. Each new high reinforced the belief that collapse was no longer possible in a modern economy. On December 29, 1989, the Nikkei reached 38,915. That moment became the absolute peak of Japanese financial confidence, status, and national pride. Confidence was total, reinforced daily by rising prices, easy credit, and self-confirming forecasts. Analysts rewrote models to justify valuations rather than question assumptions about risk and leverage. Japan was declared the future of capitalism by global media, executives, and mainstream economists. America, by contrast, was framed as inefficient, indebted, outdated, and losing the economic race. The narrative was clear. Japan had solved capitalism's weaknesses through discipline and superior design. History, it seemed, had chosen a new winner and would not reverse course again. Yet more than 3 decades later, that stock market has never reclaimed its peak level. The wealth erased during the collapse never returned in real terms for households and retirees. The promised recovery became a permanent expectation rather than an event anyone actually experienced. Generations waited for normalization that never arrived, even as costs rose and wages stagnated. The optimism that powered the boom evaporated completely and permanently, replaced by caution and fatigue. This outcome was not bad luck or unfortunate timing in an otherwise healthy system. It was not the result of external shocks or unpredictable events that no one could foresee. It was mathematical inevitability, built quietly into the structure of the boom itself from inception. The collapse was not sudden. It was encoded from the beginning in leverage and dependency. And right now, the United States is following that same sequence with chilling precision. Not accidentally, not unknowingly, but through deliberate repetition of the same monetary mechanisms. The Federal Reserve did not ignore Japan's experience or fail to study its long stagnation. They analyzed it carefully, published research, debated it openly, and still accepted the risk. Japan became a case study taught inside central banking institutions as a warning template. Every failure was documented, every misstep catalogued, every rescue examined for weaknesses. And then the same strategy was implemented anyway, because markets demanded constant support. The assumption was simple. Better tools would produce better outcomes under the same conditions. Control, it was believed, would overcome math, constraints, and the reality of balance sheets. Precision policy would succeed where Japan supposedly failed, through smarter timing and messaging. The same conditions were recreated, only larger, deeper, and more globally interconnected. December 1989, Tokyo at night, glowing with money, certainty, and elite confidence. Neon lights reflected off rain-slick streets filled with imported luxury cars and chauffeurs. Financial districts once built for bicycles now hosted Bentleys, Mercedes, and private security. Money moved faster than goods, faster than labor, faster than reality, and faster than oversight. Businessmen in designer suits closed deals over whiskey costing more than ordinary monthly rent. Consumption became a performance of success rather than a function of income or productivity. Real estate prices had quadrupled in just 5 years across major cities and key districts. Entire neighborhoods revalued upward without any change in output, wages, or real demand. The Nikkei stock index climbed nearly 300% within a single decade of optimism. Japan believed it had won the global economic contest permanently and would never lose it. Inflation appeared defeated, reinforcing belief that Japan had mastered economic stability permanently through policy. Manufacturing dominance spread across electronics, automobiles, and precision machinery, capturing global market share. Japanese firms outcompeted American rivals in cost, quality, reliability, and efficient supply chains. This success created confidence that economic fundamentals no longer imposed limits on asset prices. Corporations believed efficiency had replaced cyclicality as the governing force of modern prosperity. That confidence masked a turning point already embedded years earlier, quietly reshaping incentives. The true shift occurred quietly in 1985, mostly unnoticed by the public. 5 major nations met privately at the Plaza Hotel in New York for coordinated action. The United States, Japan, Germany, France, and the United Kingdom attended to realign currencies. Their goal was deliberate intervention in global currency markets, not organic market adjustment. They agreed to weaken the US dollar through coordinated action and sustained pressure. This decision would fundamentally alter Japan's economic trajectory by attacking export competitiveness. Within 2 years, the Japanese yen doubled in value against the dollar, shocking exporters. It rose from 250 yen per dollar to near 128 quickly. Export prices surged overnight for foreign buyers, shrinking demand and squeezing margins. Japanese goods instantly became far more expensive globally, weakening the core growth engine. The export engine driving Japan's growth slowed sharply, creating fear across government agencies. Demand weakened, margins compressed, and competitiveness eroded, threatening a national recession. Panic spread through policymakers at the Bank of Japan, who feared economic humiliation. Officials feared recession would follow the export slowdown, undermining jobs and national pride. Rather than allow contraction, they intervened aggressively with credit expansion and rate cuts. Interest rates were slashed to stimulate domestic demand and offset the export hit. Rates fell from 5% to 2.5% rapidly, flooding markets with liquidity. Cheap credit flooded financial markets almost immediately, inviting speculation and aggressive borrowing. The message was unmistakable: borrow, spend, and preserve growth at any cost. Monetary expansion became the primary tool of economic defense, replacing structural reform. Growth would be maintained regardless of distortion, misallocation, or rising systemic leverage. And Japan followed this directive without hesitation, because early results looked miraculous. Credit creation accelerated across banks and corporations, pushing money into assets first. Debt replaced productivity as the driver of expansion, disguising fragility as strength. What economists missed was the quality of this new growth and its hidden weaknesses. It was not wealth generated through innovation or efficiency, but through cheaper borrowing. It was leverage-driven expansion, amplified by financial engineering and rising collateral values. Near-zero interest rates altered incentives across the entire economy, from savers to CEOs. Saving became irrational as returns fell below inflation and yields were crushed by policy. Borrowing became the rational response to suppressed yields, rewarding risk-taking over restraint. Investment shifted away from factories toward appreciating assets because returns looked guaranteed. Japanese corporations borrowed billions to buy stocks and property instead of building capacity. Capital flowed into speculation rather than productive investment, widening the gap between paper and real. Banks accepted collateral whose value depended entirely on belief and continued price inflation. Prices rose because everyone assumed they would continue rising, reinforcing the bubble's logic. Rising prices then justified more borrowing, creating a loop where credit manufactured proof. The addiction to cheap money took hold quietly but completely, changing behavior everywhere. Each round of credit produced diminishing real returns while increasing financial fragility. Larger doses were required to maintain the illusion of growth and the appearance of stability. Beneath visible prosperity, structural fragility spread through balance sheets, incentives, and politics. Risk did not disappear. It accumulated invisibly inside leverage, refinancing, and overvalued collateral. Leverage replaced resilience as the foundation of the economy, leaving no margin for error. Stability became dependent on constant asset price inflation to keep collateral and confidence intact. The system could no longer tolerate even minor corrections without breaking interconnected balance sheets. Any decline threatened cascading failures across banks, corporations, pensions, and consumer confidence. The economy now required bubbles simply to function because growth depended on rising paper wealth. This dependency transformed growth into a trap, where success required ever more leverage. A trap with no painless exit, because any exit would reveal losses immediately. While workers struggled with rising living costs, extraction accelerated above them through finance. A shadow financial economy quietly expanded inside legitimate institutions, protected by reputation. Wealth was generated not through production, but valuation games and leveraged asset appreciation. Corporate financial engineering departments multiplied rapidly, embedded inside respected manufacturers. They were called Zaiteku, but functioned as internal trading desks chasing speculative gains. Speculation became normalized as corporate strategy, blurring the line between business and casino. Major manufacturing firms increasingly behave like hedge funds, with factories attached to justify legitimacy. Toyota generated significant profits from stock speculation rather than automobile sales in key years. Canon's financial division out-earned its globally respected camera business, distorting incentives company-wide. Reported corporate profits became detached from real production, masking weakness behind asset gains. Paper gains replaced durable economic strength, making balance sheets look healthier than reality. The banking system proved even more corrosive than corporate speculation because it controlled credit. Japanese banks operated under so-called relationship lending frameworks that rewarded loyalty over discipline. These arrangements prioritized political access, prestige, and connections rather than repayment capacity. Borrowers with connections faced virtually no lending limits, even as leverage exploded. Risk assessments were overridden by status and proximity to power, turning banks into accomplices. Interest rates were artificially low for favored clients, regardless of leverage, cash flow, or risk. Collateral standards were flexible, negotiable, and often ignored when influence demanded exceptions. Repayment schedules were repeatedly extended to avoid recognizing losses and triggering panic. Defaults carried no meaningful consequences for insiders, encouraging reckless expansion without accountability. Fear, the core regulator of risk, was removed entirely, leaving optimism unchecked. Organized crime entered the system openly through real estate finance, exploiting easy credit. Yakuza groups borrowed billions to purchase urban property and control high-demand neighborhoods. They used leverage to concentrate land ownership aggressively, tightening supply through intimidation. Artificial scarcity was created to push prices even higher, forcing buyers to chase markets. Rising prices validated the strategy and attracted more capital, multiplying manipulation effects. Banks knew exactly who they were lending to and understood the criminal infrastructure behind it. They understood how the money was being used to corner property markets and inflate valuations. They did not intervene as long as prices rose, because rising prices hid bad loans. Rising asset values made every balance sheet appear solvent, postponing recognition of reality. Risk became invisible beneath appreciation, because paper collateral masked deteriorating fundamentals. Land sharking firms known as Giagea expanded rapidly, feeding on the bubble's desperation. They used harassment and intimidation to force inflated sales from unwilling owners and tenants. One unit would be purchased, then pressure applied to neighbors until surrender followed. Entire buildings were cleared through sustained coercion, turning neighborhoods into leverage instruments. Banks financed these operations knowingly and repeatedly, treating intimidation as a business model. Politicians consistently looked the other way because confronting the bubble threatened careers. Enforcement agencies avoided confrontation with financial interests, fearing backlash and instability. The ruling Liberal Democratic Party was deeply complicit, benefiting from land and construction finance. Since 1955, power flowed through construction and land, shaping national incentives. Real estate finance became the backbone of political stability, making reform politically suicidal. Policy increasingly protected asset holders rather than workers, locking inequality into the system. Regulatory capture ensured speculation faced minimal resistance, even as risks became obvious. Wealth was systematically extracted from productive labor through rising housing costs. It was funneled upward to financial and political elites who converted credit into ownership. The social contract quietly eroded beneath rising prices, leaving workers exposed. By 1989, homes required 18 years of income to buy for average workers. Workers carried lifetime debt burdens for basic shelter, turning housing into financial captivity. Elites accumulated dozens of properties using borrowed money, stacking leverage on leverage. Money they never intended to repay fully because inflation did the repayment. Private wealth expanded rapidly on paper, while fragility deepened underneath. Public stability collapsed quietly beneath the surface because the system depended on denial. By late 1989, even the Bank of Japan sensed danger forming. Asset prices had detached entirely from wages, productivity, and economic reality. Japanese real estate exceeded the GDP of the United States, a sign of pure distortion. A square meter in Ginza exceeded an American annual salary, turning land into luxury. The Nikkei traded near 60 times earnings, pricing companies as if failure were impossible. Healthy markets historically trade closer to 15 or 20, acknowledging uncertainty. Japan was priced for perfection, multiplied several times over, leaving no margin for error. The central bank attempted a controlled soft landing, hoping to deflate without panic. Interest rates were raised slowly to cool speculation, but dependency was already locked in. It was already too late for gradual correction because leverage demanded rising collateral. The economy required constant asset inflation to survive, keeping banks and pensions solvent. When prices fell, the math broke everywhere at once, triggering forced selling. The wealth was revealed to be fictional because it was credit-backed valuation, not income. And the United States now faces the exact same choice, only at a far larger scale.